guys, welcome back. This is StockBroc. Today I'm going to be breaking down the options chain. Go over very quickly what you need to know for an options chain and kind of just some basic about the Greeks, not too in depth. Do want to do a master class on that, but at the moment we are going to do a brief overview of Tesla. We have a expiration date of 10/17/2025, which is about a month away, and we have our calls right here and our puts. So right here, this is what we call at the money. This is where Tesla closed. So let's go to Tesla closed at 410.04. So this is at the money. So anything above for our calls is going to be outside of the money. Anything below for our calls is going to be in the money. So to explain that is our call options, we are saying the stock will increase in value. For the put options, we're saying, as the red indicates, that it's going to decrease in value. So basically, out the money and in the money will be separate or opposite for puts. So as someone that is buying a put at 420, I'm saying the stock will go down. So this is going to be in the money for puts. Anything above this at the money for puts is in the money. Anything below is out the money. Because if we want the stock to go down, we need it to get to 405. So we're outside of this range, basically. And to kind of go over some of the Greeks, the ones we're going to really focus on are Delta and Theta. You can think of gamma as something, as every dollar increments in the stock price increases or decreases, delta will gain 0.0056. So it'll be 0.4656 if the stock went up. But if it went down, it'll be 0.44, I don't even know, 0.454, something like that. 0.45 something. But yeah, basically, gamma is not too much to worry about. Sometimes you can take a look at it, but we're going to look at delta right now. You can look at delta in two ways. So as the stock increases $1, basically this will increase 51 cents in value. But then also you can look at it as a percentage of the stock option strike price resulting in the money at the time of expiration. So there's a 49% chance that it won't be in the money. There's a 51% chance it will be in the money. So basically saying there's a 51% chance it'll be above $415. And so say if we're at 420, 415 would be in the money at that price. And then we have Theta. Theta is basically the time decay. So this fluctuates. So time is always against you in certain options, especially short-term options. That's why sometimes you could be right about a stock, but the Theta will eat your option alive. And you have to look at volatility, which is where Vega comes in. So Vega is basically every percent increase in volatility, Vega will increase the value of that strike price. And looking at we're looking at Theta. So basically it's costing 45 cents. It's going to be losing value of 45 cents per day at this strike price. And then here we're going to be losing 44 cents per day. So Theta and delta are very important. Of course, you're not going to just always buy something that's deep in the money and expect to make money. You have to look at volatility price. You have to look at theta. So there's a lot to it. It's very complex. But just to give you a base understanding of what this means in the options chain, these are very important to the value in your stock. And looking at the puts, it's very similar. On the other side, it's negative for puts because you want the value of the stock to go down. But this is basically what you're going to be making. So this has a 49% chance of being in the money. This has a 52% chance, 54%. And as the stock price goes down, this is the increase in value for your options contract. So you're going to be making money. So hope this helped, guys. This is just kind of a brief overview of the options chain to kind of introduce you to the options chain and learn about it. I did do a video on leaps. I'm going to do a lot more in-depth videos. So thanks for watching. This is StockBroc. Peace.